Welcome to Quiver Financial's market update for March 2024. Find out what we're seeing in stocks, interest rates, metals, and oil. I'm Colby McFadden with Quiver Financial, joined with Patrick Moorhead and Justin Singletary. Gentlemen, welcome to March of 2024. Did you know you would ever make it this way? Justin had on the calendar World War III starts or the world ends. When was that? Last week? Last Friday?
Yeah, starting March. Well, there was an AI post that came out, I don't know, it was in like September, October of last year from some AI bot that said World War III will begin in March 1st.
Okay.
So I put it on the calendar just in case.
Well, we made it. We made it through. We're good. So welcome, gentlemen. I'm glad you're here. So I'm going to try and be as brief as possible, and really, as I was doing all the homework and all the charts, everything that we do on a regular basis, and for anybody who's joining us that's new, every quarter, every 4 times a year, we give an update on stock market, interest rates, metals, oil, currencies, real estate. We don't always give an update on every single one of them in each event. We typically give an update on the ones that matter the most to your investment portfolio, as well as the ones that we're more allocated to within our accounts. So this is twofold. It allows us to communicate to everybody what we're seeing in markets. It also helps explain a little bit of the holdings that we have in some of our allocations, because if we feel that the charts and the fundamentals fit for growth, then obviously we're going to allocate towards that. So I want to start the conversation with interest rates, because it was like October. Everybody was like, oh boy, higher for longer. And then all of a sudden, the whole narrative changed around interest rates. And I don't know what happened. Everybody went from, oh my gosh, the Federal Reserve isn't raising interest rates, and now they're going to lower them. Like the narrative of the market went from, hey, we're going up to we're going down. And it's like, did people forget that they can also just kind of sit and do nothing for a while? So I'm going to talk about that and pull up some charts and talk about what to watch for, because we can't predict what's going to happen next, but there's some things that we should watch for, because if they develop, then we can get ahead of the curve with some ideas. So we'll talk about interest rates, because I think the stock market is really wrapped around the narrative that interest rates are going to go lower later this year and next year. And that's part of the reason the market has had just this like recovery high, breaking out to new highs. So I'm going to show some charts and have a conversation about, are we in the new bull market, or are we just having this kind of secondary high, and are we going to get a surprise? So both interest rates and stocks, they're really tied together right now, more than I've seen in a long time. And then we're going to talk about metals, because finally, gold, silver, gold miners, they're starting to move in the right direction. I mean, for the last 3 years, they start to get people excited, and then they go sideways and lull you to sleep. Now we're starting to see some action, so I'm going to show you the charts. I'm going to talk about where this trend could go, and also how to play it, the best ways to play it, at least how we're going to play it. And then also I'll end with oil, and really it's a little bit of an election conversation as well, because we really want to watch what happens in energy prices this year. Do they get weaponized and used against us in an economic way? I'll explain more of that as we get into the charts. So those are the high-level items. So let's start off with interest rates, unless, Patrick, Justin, you have something you want to throw out there.
Before you get into that, so Justin and I are going to kind of be asking questions as we go through, but if any of the people watching have questions, please be sure to put it in the little comment box or chat box, and we'll try and answer as either Justin and I will type as Colby's going through this, or we'll bring it to Colby's attention and make him do it on the spot.
Yeah, that'd be great. Yeah, if you guys can pay attention to the chats. Anybody has any questions, throw them in there, and we will get to them. All right, so let's hear them. So this is the chart that we put out in January when we threw out our 2024 outlooks. And so I circled at the top right, December 10th is when we created the chart. And right around that time frame, the commentary that we had was I wouldn't be too surprised if the first couple months of the year we see rates tick up a little, tick back down into the summertime, and then possibly go higher from there. Now, why am I looking for that? Why would that be something that we're curious about? So here's an updated chart, and we did see that in the first 2 months of this year, we saw a little uptick in interest rates. This is the 10-year Treasury that we're looking at. And so now I'm thinking what I want to watch for is if we see a little decline in rates and the 10-year starts to get a little bit softer here going into the summer, it's going to hold the economy together. It's going to hold the market together probably. And if that's happening, if we're starting to see rates kind of trend lower into the summer, however, we start to see oil prices increase and shelter prices, they don't even have to increase. They can just stay where they're at. But if we just get some uptick in energy prices, that could be enough to prevent the Fed from having the ability to lower interest rates. And because the inflation numbers won't get below where they are now, which is right around 3%, and their target's for 2%. So interest rates, historically, they always trade in a range based on the perception of where the economy is. And you can see this in the chart. This goes all the way back to like 2012. And you can see from this time frame that for 6-7 years, the 10-year traded between basically 1.5 and 3. If you can get the 10-year Treasury to stay in a range like that for multiple years, that's like a Goldilocks scenario, and that's great for the stock market. And I think what the 10 years trying to do here is it's trying to figure out where is this new economy post-pandemic? What is the real activity that's going on in the economy? And if things stay pretty steady, if we can stay 2 to 3% inflation rate, then maybe rates stay right in this green pattern for a period of time, and we create a new Goldilocks of between, let's say, 3.5% to 5%, and we just bounce between there and there. That would be the golden scenario, and that's what really the market has priced in right now, is my belief. The market thinks that this is what is transpiring right now. And so if that's the case, we want to really watch for what could surprise the market. And what could surprise it is that rates go higher for longer. And the fundamentals that I would have to see that happen is, like I said, I'd have to start to see that energy prices got weaponized in an election year. And that's fairly possible. We don't know if it's going to happen or not, but if I start to see that kind of rhetoric and I start to see oil prices continue to push higher later this year, even as interest rates kind of settle, then there's no way the Fed's going to lower rates in June, and they're going to have a heck of a time doing it in September, because as you get closer to November, they're not going to raise rates right in front or right behind the election. They don't want to be blamed for interfering one way or the other. So I think for all of us as investors, the good news in this is that the rhetoric around higher rates has calmed down, and we can go back to some interest rate sensitive items and start to get some dividends and income from it for a few months while this starts to play out. But we've got to be really aware of this red pattern, that if it starts to develop, that we get another 5-wave move higher, because we had one here already. So the normal technical pattern would be a 3-wave correction, and then all of a sudden we go through growth again. If we start to see that, then we'll start to come back out to people and say, hey, now you got to protect your portfolio, because when you get a run-up in interest rates like this in 2022, it does a lot of damage to lower risk, high-yielding type of portfolios. So those are the things I'm watching for. I hope we stay in Goldilocks. I hope we stay in this range. But if I start to see signs that we break out of that, I think it's something important to watch for.
You have 2 options shown there. What about the third option, to where, because we have 20% of commercial debt coming due this year.
Okay.
What happens in a scenario where inflation ticks up, oil ticks up, but the Fed needs to stave off a recessionary or a turmoil position in commercial real estate, and they need to start cutting rates so that all these commercial properties can refinance at a lower rate, so we don't have a blow up on banks, blow up on debt, all that type of thing, and rates actually do tick down.
Yeah, I see that. I think you're right. If you have a black swan event or a big enough damaging event, like if you take a torpedo to the side of the boat in commercial real estate, and let's say it's really that big, then yeah, maybe you get the Fed to react to stave off contagion in the market. That's a possibility. The reason I'm not so sure that that's a probability is that loans and real estate and all these loans that these banks have, they've been on the books for a while. So all these banks know what they have. The Fed knows what they have. The government knows what these banks have on their balance sheets. And so I feel like after we experienced in '08, how they were able to kind of feather out the failures over time. Because remember in '08 to like 2012, everybody was worried about this mortgage reset. Oh, all these people have adjustable rate mortgages and they're going to reset and that's going to be the next thing. And what I realized from that, because that never happened, is I realized that in banking and with loans, because they're so papered up, they pretty much know what's on their books and they know how they know how to work around it. So I think the Fed knows how big that commercial real estate problem is. And I think they know how big it is. They know the size of it better than anybody else. And I don't think it's that big of a concern for them. We'll see, but I think they have better. I think they have better vision on that than the narrative that you're hearing in the financial news is saying.
I think you're giving the Fed too much credit, but I don't think it's going to be a torpedo. Like, yeah, I agree that it's not going to be big enough to cause the damage, but. I don't think the Fed is as smart as you're giving them credit for.
You have to remember, this is threatening some regional banks that aren't really contagious. Like they're not prop desks, they're not trading. And it's not Washington Mutual. Washington Mutual was basically Chase of the day, right? So you're not dealing with Chase or Bank of America or that kind of size of a bank. So I don't know if the Fed's going to really worry about so many regional banks, especially when they got guys like Steve Mnuchin that are just going to come in and sweep up, for pennies on the dollar. So, and I do find I don't know, I haven't done the homework on this. I find what's interesting on that New York City bank failure. I do find it interesting that they chased Trump out of New York. That bank fails a few weeks later, and then Steve Mnuchin, who was on the Trump team in the Trump White House for a period of time, is the guy who ends up buying the bank. So I just find it all very funny. Have no idea if there's any links to any of that whatsoever. So the bottom line here is this for us, what we're doing in the accounts around interest rates is we're able, because the rapid rise is behind us, and now we're in this realm of what if, but at least the what if is tame. In this environment, you have calm waters when it comes to interest rates. And so in that environment, we can now add certain items into portfolios that produce income, are a little more rate sensitive, that we couldn't have in the portfolio the last couple years. So that's good for anybody who needs income, for anybody who's searching for things. The environment seems to be safer for us to be able to take some risk to grab for income, because if there is a breakdown in markets, I think we start to have a little bit of a tell in the charts.
So quick question would be if you go back to call it the 40s to the 80s, that was a time of rising interest rates. Obviously the 70s saw the bulk of that. And then if you look at from the 80s basically to 2020, we've had nothing but interest rates going down. I know we talked about a range, but do you think in the macro picture, the really longer range stuff, that interest rates are in this time frame of where they just are going to continue to, they might sit in a range for a period of time, but do you think that they may tick up over time based on just looking at the history?
That's an awesome question, because what we just talked about was what you would call the short to intermediate term time frame, months to a year. Right? Like that's what most people are worried about in their portfolios. How am I performing over months to a year to 2 years, 3 years? They don't really go much longer than that. They don't pay attention for that. And what you're talking about is, what if we're in this secular move where 2020 was the low, historic low, and now from this point forward, we just keep going higher. And in the chart, what that would mean is that you have 5 waves, 1, 2, 3, 4, 5. You get a 3-wave correction. And if we start to get the things that I'm talking about happening, if you got another 5-wave move after this, then Justin, you're dead on. This was a historic low. Now we're higher for longer. And what could cause that? Well, I mean, the last point on this slide, expect the unexpected, and keep in mind the long-term demographics, because we have a situation that baby boomers, right now 11,000 or 12,000 people hit 65 every day. For my whole career, everybody was saying, oh man, when the baby boomers retire, they're going to sell all their assets. They're going to get conservative. Guess what? Wrong. They're retiring and they want more risk. They're the ones who want NVIDIA. They're the ones who want all the high risky stuff, because they're like, hey, I got to make it now, baby. So they're not getting conservative. They're not selling their houses, right? They're 65 is not 65 anymore. Like, most 65-year-olds are as spry as a 40-year-old. I know 65-year-olds that are in better shape than you guys. Sorry to say, but, so it's like 65 is not what it used to be, right? So that you're not seeing the baby boomers slow down. And then right behind them, you have the millennials. And the millennials are a huge spot. You guys, Justin, you're a perfect example. You just got married. You're going to have a kid. You're going to start a family. You're going to buy a house. You and everybody in the 10-year gap around you is doing the same thing, and it's a huge population. So it's hard for me to believe that the Fed can be too accommodative, because if you look at the 70s, when all the baby boomers were of household formation age, commodity prices were getting pushed higher, energy prices were getting pushed higher, interest rates were being pushed higher, shelter prices were going up with it. So demographically, maybe we are set up between the baby boomers staying in the game and the millennials coming into the game, that you just have so much demand for natural resources, and you have so much economic activity that the Federal Reserve doesn't have to lower rates to save the economy. Because remember, the last 40 years, they were lowering rates every time the economy slowed down. So maybe we've got a demographic mix over the next 20 years that changes that. We'll see. We'll know over the next 2 years.
Just because a 65-year-old like yourself has more hair than Justin and I does not mean that they're in better shape.
Well, I'm not 65 yet, but I'm starting to feel it. I got a little pinched nerve somewhere in there. All right, so here's the thing. Interest rates, if we do find that Goldilocks range that the market thinks that we're in, which I hope we are, then when we come over into the stock market, this is what we talked about in January. We said right now, and it hasn't changed, right now the market is of one of two paths. Now, the first one was what we were a believer in all of last year, that eventually the rally was going to fail. That hasn't happened, and the window of time for that to happen is really like almost closed. Like, for this pattern to happen still has to transpire in the next 2 weeks. Otherwise, that window closes, and we're definitely more so, I can't say definitely, but then the odds really, really shift that we're in this bullish pattern, and it may not make fundamental sense to a lot of people, because it means a lot of stocks will get at much higher valuations. And so this path here on the right side fundamentally may make no sense to anybody. It could be one of those times that happens. And this is what people are expecting right now. It seems like the whole market has shifted into this belief system. So there again, okay, fine, we can allocate for this because the interest rate environment is also allowing us to do so. And then what we have to do is just watch for signs that if something changes in the next 2 or 3 weeks where this pattern on the left does develop, then it's pretty easy to move around it. But for right now, the stock market looks pretty stable. I wouldn't be shocked to see a 5-6% correction off of where we're at because we need to come back. We're at like 5,200 right now, 5,100. So the market needs to kind of come back to 4,800, do a little correction. And that's what I'm going to be watching for is in the next correction, if the stock market comes into this 4,800 level, 4,700 level, gets its footing and starts to pivot higher, then that's a really another confirmation that this right side is happening. So this is all very early stage. Like if we are going into another bull market, then right now we're in the first inning. The next correction is the second inning. And the most important thing will be, what do you do then? Because if we do have this pattern on the right side, the next market correction is where you get a chance to position for it. In the meantime, there's still a lot of things that you can do. Now, last year, one thing we were sharing with people, and I want to bring in a note of caution to the bulls and to that bullish picture, to that right side, is all last year, one of the reasons I was very concerned about the stock market is that, in my experience, is that when you have the stock market rally and then the high yield bond market and the small caps and the financials and real estate, when you have all of those things not perform in that rally up, it's a really bad sign. Usually that means that these rallies fail because these parts of the market weren't participating. So that has not really changed all that much because here we are. I think that this was what I shared in December, and then here's an update. Here we are now. All right. So on the left is the S&P 500. So you can see it's making new all-time highs. Below it is the high yield bond index. It can't get off the mat. Above, on the top right, small cap stocks, still greatly underperforming the large caps. And then you have financials on the bottom right, which now finally got peppy. Like they finally took off and caught up with the S&P 500. So if we are in a really, truly new bull market, then what should happen is the small caps and the high yields, they should break above these red lines and run really fast to catch up with what the S&P has done. So basically, this may be a precursor of what's happening here. So that's what I'm going to watch, is over the next couple weeks, if these markets can get above these red lines and stay above them, then that's another confirmation that, market is pretty damn strong. However, if these guys fail in the next 2 weeks and roll over, then that pattern of the bears is potentially there. So for me, in order for me to get really bullish the stock market, I sure would like the higher risk parts of the market to start to participate in the rally. And they've started to show signs of it, but not completely there yet. And then right in here, I just threw a little extra, traded real estate chart. Because even though it hasn't performed like the S&P, it does look like it's broken its downtrend. So that's something I'm going to watch there. And if interest rates stay calm or stay in that Goldilocks pattern, then this definitely has broken out and becomes a potential opportunity in the future. So those are the things that I'm watching, and they tell me that you can buy high yielding stocks. Like you can go out there and you can buy dividend paying stocks, which we started doing in February. We've put in a lot of dividend paying stocks, a lot of them around the undervalued areas of miners and energy. And the market is very narrow leadership. What's pushing the S&P 500 higher is still just a couple stocks. Microsoft, it's not even Apple and Tesla anymore. It's just Microsoft, Nvidia, and I mean, if you guys remember one other that might be of the Magnificent Seven, I think only 2 or 3 of them are pushing to new highs, and the others have rolled over. So this market is very narrow, and you could have a correction at any moment. That correction, where that correction ends and what happens next tells us whether we're in a bull market or not.
Yeah, I saw today that I think it was Bank of America just changed their forward forecasting on the price of Tesla from I can't remember if it was 200 to 125, but they basically downgraded it by a substantial amount.
Well, the EV car thing has, the shine, the luster has come off that. A lot of the car companies are now backing off. All the big boys have realized, the demand from the consumer isn't there yet. So, Tesla is feeling that, and now they have competition in China. I mean, the market's changed, but. I still like, when I look at charts and I look at things like Chevron and Exxon and British Petroleum and gold miners that are paying 4% and 5% and 3%, and they've been at the bottom of their trading range for a year. Those are the things that I think are undervalued in this market, and they play a catch up. And I don't mind buying stuff that pays a dividend, because even if it goes sideways, at least I'm getting paid to wait. So when I have a really narrow stock market where I know the risks, where the ice is really thin, then okay, I'll buy dividend payers. But the nice thing is the difference this year from 2022 and even the beginning of 2023 is that at least now we can go buy those dividend payers. Back then, when interest rates were rising, it was at such a fast pace, it was still too treacherous to do that. So at least now the environment allows us to go strive for some income.
You had, again, 2 options on the way the stock market could go. And I'm sure you remember in the 2000s, the mania, the craziness that was going on, the exuberance of, it was unbelievable that the market could keep going higher. And now in this year, 2023, 2024, we have cacao going through the roof, Costco going through the roof, Elf, like you said at the beginning, which is a beauty company, going through the roof, Abercrombie and Finch, which, is going through the roof. So we have these stocks that are just going mania. Is it not, a lot of people reference this to a lot of things going on in 2000, time frame that we're having now. What are the thoughts in that regard?
Well, it tells me that the Fed, that's another reason I don't think the Fed is all that accommodative in the future, right? Because those things happening tell you that there's still a lot of liquidity out there. If you can get, like in this last earnings, there were big companies that released earnings and their stock was up 20% the next day. So when you have that kind of stuff going on and you still have people buying $1 million, $2 million homes fairly easily, like when you have a tight inventory, it tells me that there's still a lot of liquidity out there. And that tells me the Fed's not going to be able to be that accommodative because they haven't accomplished the goal. It was August of 2022 that Jerome Powell said, investors should expect to feel pain. That was August of 2022. And there was some pain in 2022, but it was like October of 22, 2 or 3 months after he said that the pain stopped. So I don't think the Fed has accomplished their goal of slowing it down enough. And those stocks doing those crazy things is an example of the liquidity that's still out there and why the Fed hasn't accomplished their goal yet. When you see that stuff not happening, then the Fed will be ready to lower rates. Is my opinion on it. but I don't even really worry about that stuff because there again, like if I own Chevron, Exxon, British Petroleum, those types of things, they've been around for 100 years, and doing the same business. So right now, you just kind of take the Warren Buffett approach. And I'm going to move on from that unless you guys want to beat that dead horse.
Well, we have Steve's got a question. You want to take one from?
Yeah. Let's see. Hey, Steve, we saw your hand up. Watch, we probably got him while he's in the bathroom.
Yeah.
That's usually what would. All right. Hi, Steve. So you had a question? Yeah, we can hear you.
Okay. Yeah, I was wondering about the, I met you many years ago and I was talking to you about Bitcoin and stuff like that. And at the time you guys weren't ready for it. And I was really early on it. I've been through 3 cycles on it. Got debt free, paid off my mortgage in Newport Coast, and now building up for retirement. And now the ETFs are out. So I'm wondering what's your guys' position on trying to embrace this new asset class?
Well, I think Bitcoin is now definitely in that same category as gold, where it's been institutionalized, where people now are utilizing it as a store of value and as a hedge against certain things. So what I would expect to see with Bitcoin, that it starts to kind of get some correlation to something else, because that's kind of how markets tend to work. The ETF side of it definitely supports further upside, not all at once, maybe not tomorrow, but you just have to figure that once you make something so easily accessible that, yes, there's going to be, an easier entry point and more demand. Now, what does BlackRock do with this? Right? Because I would say I see all the positives of it, but knowing market structure and knowing the people in this business that I don't trust, I would now say that it makes that market really interesting now that you have market makers in there. Now that you truly have Wall Street in the game, which you didn't before. When you turn things into ETFs, that's a backdoor regulation. So I'm interested to see how that develops. I don't know the end result of that. I don't know if it's negative. I don't know if it's positive, but I know that it could be a surprise. So I think it now just becomes another asset that you have to consider in a portfolio, like you do, stocks, bonds, gold. While the trend and momentum is there, you take advantage of it. And if it starts to tank or go sideways, you reassess depending upon your time frame. Some people are holding this forever, and some people trade it. So there again, it's like any other investment. You got to start with what's your objective. Are you trying to trade, or are you trying to invest?
Well, I invest for the cycle, and then when the cycle tops up, then I, take care of things like get debt free, pay off mortgage, do different things. So it's like I made a mistake on the first cycle. I wrote it up and back down, so I'm not going to do that again.
Yeah.
So you have to be aware, and they are related to these halving cycles, which is just starting to come up again, but they linger on a little bit past that.
Yeah, it's definitely a developing space that is going to have legs in a lot of different ways. I think it's here to stay, and now it just becomes part of any investment portfolio allocation. So it's nice to see. It's actually nice to see something new.
Yeah, I got access to options on it through Ledger X, and after talking to you, and so that way I can hedge what I'm doing with it, and also, write calls, cover calls for income, and cash secured puts to buy at a discount. So it's been exciting.
Good. Well, hey, thanks for sharing.
Okay.
All right. Well, let's talk about gold, since we just talked about Bitcoin. And like I said, they do seem to attract similar concepts and beliefs. So here's what's been going on with gold. We have a here was our previous chart back in December. So we had talked about it looked like this was going to be a breakout, and we needed to see gold kind of pivot right here. And that's exactly what happened. This basically was about the time frame. Right here was about the time frame we were looking for that pivot. And now you've broken out above resistance. And it looks like the move is just kind of getting started here. And now, how high does it go? Give me some time. Let me see where this leg tops out, and then I can give you some projections. But right now, the trend is your friend in gold. And the nice thing is that, if you looked, I didn't put a chart of gold miners in here, but what's interesting, if you looked at gold miners, you'd see that they had kind of like traded all the way down here. So if you saw a chart of gold miners, you'd have this rise up, and then they tanked and they traded lower. And what I've seen in the years in my past is that if you have gold, the asset breaking out, and the miners have been lagging, then all of a sudden they do play a catch-up. So that's what I'm watching there, because we have a decent allocation of gold miners now inside the accounts. And so right now, the trend in gold looks positive. What could be the flip side is basically you break back below this 190 level, which doesn't seem likely now, but anything can happen. That becomes your stop loss level. And eventually, once we see where this rise starts to peter out, we'll be able to create another stop loss level a little bit higher. So the trend looks good. And I think that I like what I see there. Fundamentally, the dollar, gold has had this much strength, and the dollar's been pretty strong. Normally you see gold make runs like this when the dollar's had a lot of weakness. And the dollar as a currency compared to other currencies has been very firm the last year and a half, while gold has been starting to break out higher. So gold is acting on its own, and I don't know if that's a precursor of concern, but it is doing what it's doing. Justin, I know you had some gold necklaces you wanted to share.
Well, the last time I talked about gold to a client, he was like, "Gold's not sexy," and I said, "Well, if gold hits 2,500, is gold going to be sexy at that point?"
Gold, you know what? Gold's not sexy. He better talk to Mr. T.
Yeah.
I don't know. Yeah, I mean, it's not sexy, and everybody's going to criticize it, but it's moving, and there again, when I look at the gold miners, and here's some companies that are paying 3%, 4%, 5% dividends, and the thing that they pull out of the ground and sell has gone up in price, and their share price has been at the lows for the last year and a half. It seems like a dislocation to me. And the best way to make money in markets is to find dislocations. So I think this is a good one for people to pay attention to. Justin, you have anything to add to that, or should I move on and then wrap it up with oil?
We can move on. The only thing that I think, other than the Bitcoin conversation, a lot of these exchanges have, fortunately, unfortunately, I guess for those that aren't participating in them, a lot of these crypto exchanges have, ways for you to access, gold. So you can trade cryptos, you can trade gold and silver, but you can't trade anything else. So I think there's, it's probably a small market, but.
Well, I could tell you.
It's interesting.
I can tell you right.
Dollars.
I can tell you right now. I'm going to go on a limb and tell you that that Steve guy's a jerk, because he stuck around just long enough to brag about his winnings, and then he bailed out. So.
Well, I think what's interesting is like you touched on briefly is, usually in the past when gold has started to rise, you've had a weaker dollar. So what's interesting is that where we are and how these things are starting to shake out, because I feel like there's probably, you have stock markets hitting new highs, you have the ETF Bitcoin stuff, you have gold rising, you have dollar staying strong, so there's these weird things that are going on. And I feel like those are indicative of times that, are not a bull market in front of us, but you've been around more markets than I have, but at least the few that I've been around,
well, as you
play it the same way.
Yeah, as you say, like talk about all those dislocations, how everything's not all moving in one mass. You can see it in portfolios. Most people who have a diversified portfolio, they can see their portfolio struggling the last 2 or 3 years because there's been a trend in one area but not another. And like you haven't had a situation the last 3 years where you have multiple sectors, multiple asset classes all moving in one direction. You've had situations where stocks move and bonds go the other way. Like you've just had this horrible tug of war, and that hasn't ended. I think that gives evidence that the Fed is if this was a baseball game, the Fed is in the 7th inning of their process. Like they've subtracted enough liquidity to create these dislocations, all this unevenness in the market, but they haven't subtracted enough liquidity to really bring all of them down and get them to reset at a lower level, right? So as you were saying that, it made me think, well, okay, we'll watch for the future. Does the Fed continue to extract, are they just trying to figure out where that liquidity level is, where that teeter-totter is? Because that's what they did as they lowered rates is, and we talked about it for years that they were pushing on a string, and then boom, after the pandemic, they caught fire, inflation came on. This is the same process, but on the other side. They're now going to have to push on the interest rate string to figure out, okay, where does that pull enough liquidity out so we can slow the economy down and we don't have 9% inflation? So I think what you're seeing in the markets by people's portfolios and by all these asset classes kind of fighting over the last couple years and even into this year is just that the Fed is late in this tightening cycle, and you've taken enough water or liquidity out of the system to make certain areas dry, but not all of them. All right, let's wrap it up with oil. Yeah, let's wrap it up with so oil, this is what we talked about. We'd like to see oil continue to stair-step higher. That's essentially what it's been doing. In fact, it's been doing this scary little coil up. I know today it was up about 2%, so we may have started to break out towards this 80 level on USO. I haven't looked at a chart at the end of the day. But boy, oh boy, this is not what you want to see if you want the Goldilocks interest rate scenario. Oil really needs to stay between, like USO would need to stay between 65 and 75 in order for us to stay Goldilocks. If oil starts to break out later this year, and if it gets weaponized, if Saudi, Iran, Iraq, Russia, if they weaponize oil to influence the election in some way, that's something we got to be aware of. For right now, it's going to help the Chevrons, it's going to help the British Petroleum, it's going to help the Exxons, but be careful because eventually at some point, high enough oil prices will bring in the recession and breakdown in economy fears. So right there again, the trend is there. If you're in oil names, enjoy the trend. It's helping us, but it's something that we want to watch and develop over time.
Yeah, and I would just add that, with the whole electric car market, though it's small in comparison to, the gasoline cars, you're seeing a shift with the bigger, American manufacturers as well as the Japanese manufacturers, as far as they're cutting production when it comes to their fully electric vehicles, and they're increasing production when it comes to their hybrid/electric vehicles, which is essentially something that still takes gas. So, I think over the long term, or, by long term, I mean the next, 20, let's call it 10 to 20 years, it's not going anywhere. And to your point of, we have this whole new generation of people that are going to be driving, taking kids to soccer practice and doing different things. All of those things take energy, and energy costs money.
Yeah.
So I think that, in the long term, this is probably one of the last stages of energy prices rising over time before something else replaces it entirely at some time in the distant future, is my personal opinion.
Yeah. Corporations that have been around for 100 years are pretty smart and know how to survive. And, the Shells, the British Petroleums, the Chevrons, the Exxons, they all dropped the oil name from their title a long time ago. And they're all energy companies. And they're now the biggest owners of patents in anything that has to do with solar and wind. And we said this years ago that they were just going to wait until those markets develop enough, and then they're going to come in with their deep pockets and ability to scale, and they're going to take it to the next level when it makes sense to them. They'll let all the venture capital guys, all the small guys burn their money up, and then they'll come in and buy the assets, cheap on and that's essentially what's happened over the years. So oil is not going away, but you're going to see, I do believe you're going to see a world over the next 20 years where you have a much better balance between all these fuel sources, like all these energy sources. You're going to have a better balance than what we had before. And that will develop over 20 years. It's going to take a long time. And it needs to take a long time, because if it did anything shorter than that, it disrupt the whole friggin' economy that we're in. There's a lot of jobs, there's a lot of businesses, there's a lot of cities like Houston, Justin, that really do need to make sure that the energy game stays alive. So I don't think you're going to see anything in that space change overnight, because it affects too many people. And so it's a 20, 30-year process. Yeah. All right. Well, I think that wraps it up. Here's the bottom line. So bottom line on oil, the trend is there. We're going to watch to see if it gets weaponized. Energy names should benefit from it. And bottom line of the whole presentation, folks, is that you can, right in this particular environment, we can cautiously enter into equity markets, especially if they're more dividend-paying type of equities, and especially in undervalued sectors. So a lot of people have been asking us, hey, I have cash that I've been sitting on. Yes, I've been getting my 5%. I'm happy with that. Is there something else I can do in addition to that? Well, now, because of the environment that we're in, the list has gotten a lot longer of what you can do than what we were saying last year. The metal trends still look strong if people's risk tolerance can handle it. Oil prices look firm. So it's like we've said earlier this year, it does appear that we're kind of going into this phase where you have a situation that maybe commodities for multiple years have just as much growth or opportunity as some individual stocks or the stock market itself. And so this is something that we're going to continue to watch and develop, because right now, a lot of those trends look like they're very early. And we really want to watch to see if this pause in Fed interest rates, it's helpful because it allows us to add more rate-sensitive things, increase our income, and then we just have to watch over the next 3-4 months how the inflation numbers play out, and we can then determine whether those more interest rate-sensitive items can stay in a portfolio for longer, or do they need to be more active items that get brought in and brought out tactically. So that's the bottom line of what we're seeing in the markets right now. For anybody who's curious about their portfolio, if you'd like to receive a free review of your portfolio, if you have a 401k and you'd like to have a review of the 401k, contact us, send us an email, give us a call. We'll be happy to give you a review. For any clients, if you're curious about how things are going, reach out to us and we'll give you a fresh update. Gentlemen, thanks for joining me, and have a good rest of your evening.